Explain the difference between getting our taxes prepared and tax planning. How are they the
Sure.
same and how are they different?
While both getting your taxes prepared and tax planning are essential components of managing your finances, they serve different purposes and involve different approaches. Tax preparation is typically a once-a-year activity that's conducted during the tax filing season. In contrast, tax planning is an ongoing and proactive process that involves making decisions throughout the year with tax implications in mind. So, bottom line, tax preparation is reactive, focusing on the past year's financial activities, and tax planning is proactive, involving careful consideration of future financial decisions to achieve that tax efficiency.
Barb, I know that some financial professionals, they do have a part of their office that does tax preparation. What is your status? Do you provide any tax advice or tax preparation at SF Financial?
We do not do the tax preparation. We have someone that we refer our clients to if they need that service. But most of the planning that we do, is with taxes in mind, and so we do touch on it. And we use that overall comprehensive, holistic approach. And certainly, taxes are right at the forefront.
They sure are. So, with you in your office, when should we start thinking about tax planning for the future, Barb?
Well, the earlier you start, the more opportunities that you may have, to optimize your tax situation. So going clear back to even your early career, taking advantage of those employer-sponsored retirement plans like your 401ks, and consider even other tax advantage savings vehicles. Whenever there's a major life event, such as marriage or home ownership or the birth of the first child, consider how those changes impact your tax situation, and look for maybe the tax credits or the deductions and things that you'll be able to utilize. Now, as you approach retirement, typically in your 50s, evaluate your retirement income sources and distribution strategies. Understand the tax implications of different retirement accounts, and consider Roth conversions, which can potentially provide tax-free income in retirement. And I'd really encourage everyone to do a yearly review of your financial situation. That's what we do for our clients here, is that annual review. We want to assess your investment portfolio, consider tax loss harvesting, and stay informed about changes in the tax laws.
I wouldn't want to go online and read the tax code, Barb. Oh, my goodness.
No.
Yeah. And, you could go online, and it probably is changing now and then. We know the tax code is not set in stone and can change from one presidential administration to the next. We have some big tax changes coming up just 2 years from now in 2026. How important is it, Barb, to take advantage of the tax planning opportunities we have right now before there are some changes coming our way now and in the next 2 years?
Yes, and that is an important date that you brought up, that January 1 of 2026. We know that there will be a change to our current tax code. So taking advantage of current tax planning opportunities before potential changes, very, very important. So, for example, if you believe taxes will be higher in the future, look for ways to reduce taxes in the future, especially when it comes to your retirement accounts like your 401ks, your IRAs, your TSPs. Ask yourself the question, would it be advantageous to convert some of those dollars into tax-free dollars? Pay the tax today when we know what our taxes are versus later when taxes are potentially higher. And also keep in mind, changes in the tax code can mean paying more in capital gains as well. So it's better to take the gains maybe today rather than later. So a lot of things to look at, and that's why it's important to really have your team put together that is going to help make sure that you're not paying any more in taxes than you need to.
Right. Barb, let me ask about the client experience for you at SF Financial. When people come in, are they aware of January 1st, 2026? What do they bring to the office for you to look over and say, Barb, 2 years ahead of the game here, what should we be doing right now? Have you had some client experience on that already?
I would say folks are not aware of January 2026. And when I bring that up during our meetings, they're very surprised and they would like, more information. What does that mean to them? And even though we don't know what everything is going to look like, what most of us can deduce is that we believe taxes are going to be higher in the future. So looking at your overall tax return from the previous year, looking for things that maybe really jump out at me is certainly something that I ask folks to bring in their tax returns so we can look at that and then refer them back to hopefully their tax person that can help them. But we're going to, there's different types of tax folks too. Some that just basically do your returns, and there are going to be others that, help you plan.
Right. Well, here's another thing we may be aware of or may not know at all. That age when we all have to start taking our RMDs, our required minimum distributions, is 73 years of age now. Do people know about that? And what impact do the RMDs at the age of 73 have on our taxes?
And it's funny because I just had someone in the office this week that was, it's like, okay, what's the 65, age 65? What's the 70 and a half? What's this? And so all these numbers get mixed up and they don't really understand, what number is for what. And certainly the 73, because that just happened this year when RMDs changed to that number. And in the future, it's going to change to 75. So it's hard to keep up with all of this, and that's why it's helpful to have, a retirement planner, someone who's going to be keeping you informed of these upcoming dates, things that you need to be aware of. RMDs, they're taxable income in the year that you take it out, and this additional income, it can impact your overall tax liabilities, and it can move you into a higher tax bracket.
Sure can.
And it can affect the taxation of other income sources, such as your Social Security, and it can impact the calculation of Medicare premiums, and it could cause you to have a higher premium on your Medicare premiums. And if you don't take the required minimum distributions, or you take less than what was required, maybe you just didn't know, you didn't understand, you didn't calculate correctly, there is a 25% penalty. So it's not something to take lightly. And it's also important to really have strategies that can help make sure that, that you don't have as much taxable income that you, and it's just all part of our process of helping our folks retire financially fit.
And doing that so you don't give the government more money than they're entitled to. You keep more of it in your pocket is the whole idea of tax planning.
It sure
but
is.
The 70 and a half, that used to be the RMD age, wasn't it, Barb? Was it 70 and a half? And when she was mentioning that? Yeah.
It was 70 and a half, and then it went to 72, and then this year it went to 73. So it's changing, and it's hard to keep track of all of this. And I get it. It's overwhelming. So that's what we're here for, is to help folks make sure that they do it right.
Well, we sure feel a lot better after a session with Barb Swiatek at SF Financial, helping families in the heart of Colorado for nearly 25 years now. So when you have your ducks in a row, you feel a whole lot more confident, a lot better about it. And Barb's number to reach out to her is 800-883-1518. Well, the IRS Comprehensive Taxpayer Attitude Survey, that sounds interesting, Barb.
Yes, it does.
And what did they find? Well, they found that about half of taxpayers do use paid tax professionals. But who should we turn to when it comes to tax planning and retirement? Barb, can you, in this part of the show, go over some of the different types of financial professionals like you or who are different from you, and the benefits of working with a retirement planner?
Sure. When it comes to tax planning in retirement, Ralph, there are several types of financial professionals that you can turn to for guidance. And I think each professional has, a very unique set of skills and expertise. So the first one is a CPA, which is your certified public accountant.
Sure.
They're licensed professionals. They have expertise in accounting and taxation. They can assist with tax preparation and provide tax advice. And they also help with filing the taxes. Then you have your CFPs, and these are your certified financial planners, and they're financial planning professionals who have an expertise in various aspects of financial planning and taxation, including investment advice and tax planning. We also have retirement planners, such as myself, and we specialize in helping individuals plan for a financially secure retirement. Typically, we address, income planning, Social Security optimization, tax-efficient withdrawal strategies, and we focus specifically on the unique financial challenges that individuals face in retirement, and we can help create a comprehensive plan, which we call the Financial Endurance Plan, that integrates investment strategies, tax planning, and other retirement-related considerations. And you asked, what are the benefits of working with a retirement planner such as myself? Well, for us, we take a very holistic approach, and we create that financial endurance plan that aligns with your overall goals, and it includes really your income, your investment, your tax, your health, long-term, as well as estate and legacy planning.
Barb, what are some of the strategies we could consider to help keep more money in our pockets in retirement? Can you go over those for me?
Well, certainly we want to maximize our pensions and our Social Security income, and we want to minimize the taxes. So looking for tax-advantaged accounts, sometimes doing a Roth conversion, those type of things, so that we keep more money in our pocket, especially in our retirement years, and making sure that we have balance with our investments and that we take, and just know the different strategies that could be advantageous and beneficial to us to keep more money in our pocket.